Hello, everyone. Hopefully you can see me on screen and hear my voice. And now, hopefully you can also see the screen I'm sharing. If you um, want to chat in and confirm that, that's great. Thank you. Awesome. Hey, sweet Richard. Good to hear you guys. Alexis. Yeah. All right. Nice. I have some bad news, and that is that today is my last week, my last show doing this. Monday night little broadcast here, and so hopefully we can make it a good one. But I will be doing the class the next couple of weeks. That the supercharging your trading results. If you aren't aware of that, check out the channel and find out about that. But I am going to be doing the 2 4-hour class coming up. Really excited to get to share some time with you guys doing that. All right, I want to tell you about what I think is probably the easiest money trade out there. And it is ticker symbol TBT. Now, you might look at that and say, that doesn't look like easy money to me, Gordon. It looks like it's going down. It's going to be a loser. Yeah, I know. Long term, I think this thing is going to trend higher. Let me explain why. So right now, everybody knows that the U.S. Federal Reserve is planning on raising interest rates. And that's through the course of 2022. They say they're going to raise them 6 times, right? And that's going to take their target rate from, 1% to like 2.5 or something. And that's 2.5% doesn't sound very high, but mortgage rates, bank lending rates, they're all going to kind of, spread out and go higher still. So like right now, mortgage rates used to be in the 3s, they moved to the 4s, and now they're starting to creep into the 5s. And by the time this is done, they'll be up to 6 or 7. Now, when mortgage rates go up like that, then in order for bond investors to be attracted into bonds, then bond rates have to go higher as well. And that's municipal bonds or corporate bonds or US Treasury bonds. And if, in fact, US Treasuries start raising their rates, then their prices go down. And if their prices go down, then an ETF, which is based on the idea of shorting bond funds, were out there, then its prices would go up. That's what TBT is. That's what this trade is. So if we know that interest rates are going up, then we know that bond prices are likely to go down. So why not buy something that is going to profit from that? TBT. So TLT is the bond fund for 20-year treasury bonds, 20-year or more. So this is what they call the long bond and a fund based on the long bond. Now, if you were to buy a bond, the way bond buying works, you go out there and you hand the U.S. government $1,000 or $10,000 or $100,000, and then they pay you interest payments back. And then at the end of the bond, at the maturity of the bond, you buy a 5-year, 10-year, 20-year, whatever. When the bond is done, then they give you all of your original money back. So you've been getting all these interest rate payments along the way, and then you get your original money back. That's the way bonds work. I mean, the sort of standard. There's all sorts of other ways to get it, to do it. Like you could get your principal and interest back along the way, and so there's all sorts of variations. But what I described is the basic thing, right? So if you put your money into a bond and then bond prices change and interest rates change, well, that doesn't affect you. You still get what you signed up for originally. if you're okay with that, if you're okay getting the same interest rate that you started with for 20 years, no problem. But if along the way, all of a sudden, you know, the bond rates were to go, let's suppose you signed up, and the time you signed up, you were only getting 1.5% interest. And then about a year later, all of a sudden, if you had started then, you could be getting 3.5% interest or 4 or 5% interest now because bond rates went up so much. And so you're sitting there, you're stuck in this 20-year bond, and you're only getting 1.5% interest. Whereas if you were to sell the bond and then restart it, you would be able to get 3 or 4% interest. And so that sounds really attractive. The problem is, what if you were to sell the bond, sell it to somebody else, and they would pay you, instead of like your original 100,000, they would pay you the going price of the bond. Well, that's the rub, is that if you do that, then you get out at a time where the bond might be lower priced than where you bought it. See, so like if you were to have bought into this bond fund here, the price of that bond fund was $152. Right now, the price of that bond fund is $132. And this is just basically since the beginning of 2022. So that bond price has really, the price of the fund has really dropped. And if you were to sort of do the math, you realize that, hey, if I gave $100,000 and then I said, all right, wait, give me my money back because I want to go get higher payments for it, you're not going to get 100,000 back. You're going to get something like, 88,000 or 92,000 or whatever back from it, right? And so it's really a bad deal. Rising interest rates are really a bad deal for people who are holding on to bonds. And that's why ProShares created this fund here, TBT, so that if you are holding on to a bond and you're losing ground, to those rising interest rates, you can put money in here to sort of protect yourself from that. That's the idea. And that way, if your bond price drops, then you're gaining from here. You'd have to put extra money in to protect whatever, but that's the structure of this fund. Well, the flip side is you don't have to be a bond holder to play this ETF. You just buy it. And so my idea is, as long as interest rates, and we see this is where it's been in the past, right? Why is it going down and down and down? Because bond prices have been going up, because interest rates have been going down. But it's possible we've hit a kind of a turning point here. In fact, if I were to overlay TNX, so TNX is the 10-year interest rate note, or 10-year interest rate. 10-year, the interest rate yield, interest rate itself on the 10-year note. That's what that is. The new less scale, I'm going to move it over here. You can see that these things run very similarly. And if I go way back, if I say, all right, let me make this a weekly chart. If I go way back in time, TBT hasn't been around that long, but TNX has. Come on, guys. Give me the data. No? No, let me just do this for a quick second. TNX, I'll change that back to TBT. There we go. All right. So if I go way back in time to 1980, this is what interest rates have looked like for years. For decades, they've been going down and down and down and down and down. And as long as interest rates keep going down, then bond prices keep going up. Now, we've spiked above this, back in 2018, we spiked above that, but they came down even lower, regular market fluctuation, COVID. Now we're coming up out of COVID. Now what we've got is crazy inflation going on. And if we go back to these days, that's why these interest rates went up. Right through here, they had the oil embargo, the energy crisis, people called it, on through here. So high oil prices rising and they're continuing to go higher. And then on the back of that, interest rates just got way out of control. And so there were, interest rates of 14, 15, 18%, and people having to buy houses, in double digit interest rates. I have a brother that was in the construction business. It was going gangbusters all through here, but it just died right in there because interest rates got so high, people couldn't afford to buy houses. And it took a few years, and then, there was this savings and loan debacle and all that bit. But from that point on, housing got more and more and more affordable as interest rates slowly dropped down. And more importantly, inflation got under control. While inflation was going out of control, interest rates had to go higher and higher because people were looking for investments that would keep up with inflation. And that's where we are now. Now, do I think interest rates are going to get way back up here? I have no idea. I don't know that they're going to get that high. I kind of hope not, but I also hope inflation calms down. And so I don't know which of those are going to win out. What I do know is that the Fed already told us that they are planning on taking interest rates significantly higher. If we go back to the time frame where interest rates were as high as where the Fed says they're going to take them, I think we've got to go back to, like in this area up here. So now, up in this area, they were around 4%, and then they dropped down to 2%. And so right in here, that is, where's that going to be? I got to find a way to, well, I'll just draw this line. Yeah. Okay. Right. So this is the area where the last time rates were that high, or Fed rates were that high, that these 10-year note rates went. And so as you can see, they've got a long ways to go. So if we know that the Fed is going to go here, why isn't the market just jumping straight up there? Well, first off, that's a really, steep jump that has occurred just in the past 2 or 3 months. And so maybe it will, maybe it'll just run right up there. But the answer is that these rates are kind of what the effective mortgage rates, I mean, the mortgage rates move on this. And people who sell mortgages, they don't want to raise rates. They don't want to raise rates any more than they have to. They don't want to raise their own rates any more than they have to because they know they'll lose business. So everybody knows the Fed's going here and they know we're here. But because they want to sell more loans, they're going to try and keep those things from going up, their own rates, keep from raising them any faster than they have to. And so that dynamic, that market dynamic, what that means is that's going to have this, it's going to possibly create this longer, slower, steadier, from now to the end of the year, here to there kind of thing. Even that's still a fast move. And as long as that is what TNX does, well, TBT is not going to be that far behind. As you can see, if I sort of line these up at the bottom, TBT and TNX are tracking, pretty nicely, right? You can see here even that TBT came up faster than TNX did just since the beginning of the year. Let me zoom in and make that comparison. All right. So actually, yeah, they're pretty similar. TBT has pulled back, and yet TNX is charging forward. So as long as TNX continues to go higher, you're going to see TBT go higher too. Now, a week ago when I set this up, and I wasn't able to be here last week, but this is what I was going to talk about, and that was the trade setup I had in mind. Was here, let's go ahead and consider an entry here, and then put our stop loss down here. Well, came way back, uh, and who knows? Maybe it's, I mean, the stuff doesn't go straight up. It's up and down, right? But you want to give it enough room. I believe that because this is likely to be a long term trend, you could pick your entry anywhere, and as long as you give enough room for it to fluctuate, and you take a smaller profit, then that's a trade you can keep doing over and over again, right? In fact, this exact same setup, if you were to have, let's see if I can, yeah, multiple. If I were to just put this anywhere, right? If I did it there, that would have been profit. If I had done it there, that would have been profit, obviously, because those ones just went straight up. If I'd have done this here, that would have been a loss. If I'd have done it here, though, or here, right? Then it would have been a profit. So as you can see, it's a pretty easy money trade if assuming you give it enough room. And maybe the rule you add to it is trade at least after one candle. If it's going up and you see green, 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 wait until you see at least one, or maybe two. I mean, the problem is if you wait for two, then you might miss a thing like this. See, this would have been a fantastic trade, right? You get here, boom, you're right in it. Next green candle, boom, you're in it again. You can make so many wins with this structure. Occasionally you'll have this longer, you got to wait type of thing. But if you set up the trade like this, then it's just, I think it gives you lots of opportunities. Now you could just say, forget it. I'm not going to put in any stop loss. I'm just going to buy it and hold it and sit back and let it go and go and go. That's not a bad approach either. The question is, could you make more money somewhere else, right? Because this thing isn't going to fly to the moon. This isn't going to become a 10 bagger, right? I like the idea of taking a bunch of trades just over and over again, knowing, maybe you lose one, but if you're not trading right at the top, then you'd be able to get these over and over and over again. And my guess is that if you did that, you could actually capture more gains than because you capture this, you capture this, you capture this, you capture this, capture this. It pulls back, and then you capture this, and then you capture this, and then in other words, you put all those gains on top. I think there's a chance you could get more. You could do better than just buy and hold if you were active on this. But if you don't like the idea of being active on this, great. Set your stop loss like 25% back and hang on. So anyway, that is what I think might be the easiest money trade. I've added it to my watch list, and I'm still running on the ill-timed trade. I got to wait for that thing to come out and come back up, but I haven't been stopped out of it, so it's still going. All right, now with that in mind, let me do our screener and see what's looking good for the upcoming week in low-cost growth stocks. So just to preface this, the Russell 2000 and the Russell Microcap indexes have just over the past couple of days started to outperform the S&P 500 and the NASDAQ, which is really interesting because it means that people are just looking, they're hungry for good gains. So these are stocks that you should probably be trying to find some good opportunities in. And I'm just going to run through these. That's an interesting one right there, just by the look of the chart. It's oil and gas. Anything that's oil and gas, you can see a bunch of these are here, are that. In fact, let's sort these by industry and take care of the oil and gas ones first. You know, these are all going to look like they have opportunity. The problem is you just never know when that oil trade is over with. There's so much manipulation and even not just manipulation, but perception in oil right now. Oil prices aren't running entirely on supply and demand. They're running on what people expect supply and demand is going to be in the future if the Russia-Ukraine conflict continues, or if somehow that conflict widens in any way, or whatever, right? You know, however people speculate, and that is going to drive. Oh, we got to buy more. But the reality is that. Oh, sorry. If I go to Forex Factory and I look at the, I got to go to Wednesday. Crude oil inventories, right? Yeah, let me just double check this really quick. So the Energy Information Administration, this is just the change. So I got to go find a chart that has the total, but this is the change in oil inventory. Now, the way gas prices are running, the way oil prices and gas prices are running, you would expect that oil inventory was dropping because supply was weakening, or tightening, right? And there's just less of it out there. And so people have to buy more. But look at these changes, right? Since the beginning of the year, these come out once a week. We had each one of these, as it goes up, that's a decrease in supply or an increase in demand. If it goes down, that's an increase of supply. So here we had a decrease, there we had a decrease. Here we had an increase of supply, February 2nd, increase of supply, February 9th, increase of supply, March 2nd, increase of supply, March 9th, increase of supply, March 23rd, increase of supply, March 30th. Yeah, we got a couple going the other way. But what I'm pointing out to you is that most of this is down. And down means more supply. Don't ask me why. When you see prices running up 25, 30, 40% higher than they were, and yet we're getting more supply, we are not having a shortage of oil. That's not the reason prices are going up. What that means then is that the prices are going up in a somewhat artificial way. And as long as prices are going to go up artificially, then that means they're not sustainable at their levels. So, here went oil prices way up, and now they're trying to kind of go up still. But unless supply starts constraining seriously, unless all of a sudden there just isn't oil out there, then these prices are all overdone, and they're gonna have to come back lower in order for these oil producers to actually start selling away their excess oil, because that's what they have right now is excess oil. It's mind-boggling to think, but they're kind of holding on to it, thinking that prices are going to skyrocket and go higher because Russia, Ukraine, I don't know, right? So that's really, I'm nervous about taking any of these oil and gas company trades. They're all excellent looking trades if oil prices continue to go higher. But because of what I just explained to you, I'm nervous about all of these. I think any one of them could come back. And so I wouldn't consider these great ideas to try to trade on. This one here, REIT mortgage, no, it's not looking good. And then we'll come back down here, medical devices. Yeah, see, this one I think actually looks pretty good. SRTS, we've talked about it before, I think. But as you can see, it's trending down. Looks like it's on a little bit of an upward bounce. Heritage Insurance, this one's under acquisition. Okay, Dolphin Entertainment. I don't know anything about them, but that chart looks pretty good. I guess I would dig in to find out a little bit more of that. You know, what's the backstory on that one? Wow, so this is interesting. CPS. See, that first thing, it goes up and then it sort of holds there, and then you get that next one. It's like you really want to try to catch the in between move, where it goes up and sort of pulls back. I mean, I've said this before, and so I hope you don't mind hearing it again. But the way that you find out whether or not you're in the in between, or at least potentially, is you check the volume. What you're looking for on volume is that there has been an increase in the average volume being traded. And let me show you what I mean. When you have charts that have these really big spikes in volume, it's a little harder to tell, but we'll be able to figure it out. I think, in fact, we could see it right here really easy. All right. So this stock releases earnings, and for some reason, people don't like the earnings, but then kaboom, right? See, there's this huge volume spike here. But notice the more important thing to notice is look at where it was before the big run up, right? What is the average volume amount? Down there around 100,000, 87,000, something like that, right? So 100,000 or less all through here. Spike goes up and then it comes back down. And when it's there, what is it trading? It looks like it's trading a little higher, not much though, not much. It's about 100,000, and you know, so here it's like below 100,000. Yeah, you can see the lowest ones are down 40 and 50, and the but the lowest ones here are 70, 80, 90. So the average volume has increased. This is the key. It goes up, and when it comes back at this higher price level from where it was, a new volume pattern, new average, you know, even the lowest ones are trading at higher volumes. So there's more interest. People got really excited about it. They jumped in and they're hanging around. They're still here, right? That is, I mean, it doesn't always do this. It doesn't always go from here and then boom, up again. But if it's going to do that, this is so much more frequently the case. And so when you see a jump and then a pullback, but it's the high volume hangs around, that's a good one to try to take a shot at. Now it might still be that, right? My tactic would be, see, so we've jumped right up to where it was before. So my tactic would be wait till this thing pulls back, and then let's see if the average volume is up in the 150s or something. You know, if it's more volume, in which case then that would be a good shot to take. Right now, I don't feel like that is. Okay, there's one, UTI, that is, it's taken a long time. And so it's taking more time than we want, but it definitely has the pattern that we're describing here. See, there's a big jump, went from 750 to $9. Okay, did it before here too. See, $6 to $9. It went running up, and see how the volume was here, spike happens, higher volume. This spike happens, much higher volume, has gone down, has come back up. So I really like the look of this. We've got earnings up ahead, got to be prepared for some fluctuation. If you did this trade, you're probably going to do something like, you know, getting in here, setting a stop. Probably I would go ahead and give it all this room. I know that's a lot, but you know, you're in at 9, you're out at 772, maybe 770, and so that's $2. And well, here, we'll do it this way. In wherever it is right there, and out 225, 673. Oh, no, that's much. 125, is that? Yeah. Okay. So out $1.25 lower, and then we're going to be looking to take profit at 67 cents higher. That's, risk 2 to make 1. That's my standard wolf style trade. And of course, you'd switch it up if you wanted to do something different. That is, tighter stop and longer profit target. That would reduce your chances of winning, but when you win, you'd win a larger size. So, you just have to make your exits fit the kind of trading style you like. And so anyway, I think I'm going to leave it with that. The UTI trade is I mean, it looks like this giant setup on the chart, but it's all a matter of scale, right? Okay. In the weeks that I've been doing this, months now, in fact, what I talk about are just entries. But as a trader, you come to find that your biggest money has more to do, the best money you make has more to do with how you hold, maintain, and ultimately exit your trade. It's one thing to make a good entry. That's great. But you make more of your profits and gains along the way as you manage your trades. That's the kind of stuff I'm going to be talking about in the class in Supercharging Your Trading. We'll talk about something I call the fractional scale-in, how you can make even better entries than this. For example, UTI, it's not going to go just in and straight up. Most of the time, actually, I can tell you, it's 58% of the time, it will not go straight up. It will fluctuate and come back. And so you can take advantage of that by having this sort of plan for how you enter strategically. What does that look like? How do you do that? How do you know that mathematically you're getting the best possible, bang for your buck with that strategy? That's what I call my fractional scale-in methodology. I'll be teaching that. And there's also something that some people call pyramiding, or what I call the multiple scale-in technology or technique, where you're not trying to necessarily get the best entry, but you're just going to assume, hey, if we got a good trend, I'm going to ride that trend. It works really great with Jaguar or polar bear style trading. But with wolf style trading, the fractional scale-in works a little bit better. So either one of those, however, my best trades are where I have combined both of them. And that works fantastically in the Forex arena, better than in stocks. All of these techniques are so much better applied in Forex trades and than in US stock trades. Now, Forex trading for years has just been really choppy sideways kind of stuff. But now that we have the potential for interest rates, like the TBT trade, to continue moving in one particular direction, then that means the US dollar is going to be moving in one direction. And all US dollar pairs are similarly going to be going that way also. SSRA, okay. Let me go ahead and put that one on. SRA just. So I had a trade on for SRRA and it just hit and took profit. That was what those little blips jumping up were. Nice. SRRA is actually another good one to just try and hit these short little ones. So anyway, so does the new quarter make any difference? Paresh is asking. The context of that of my comments and that question, I'm sure. I'm sorry, Paresh, I missed that question. The new quarter, at the end of month and the end of quarter, does make a difference for like stocks dipping down, stuff that is dipped down, then you want to jump in. But that has more to do with large cap stocks than small cap stocks. Does the new quarter make a difference for the idea that people are going to be interested in coming to go after small cap stocks? Uh, the quarter is all about institutional investing. Okay, so if institutional investors have shifted their strategy, then yeah, that's what you're looking for. And I feel like, and you might have been asking that, it's like, hey, small cap stocks are coming on. Yeah, that might be the case because institutional investors shifted their money to small caps. All right, now back to the bit about trends. So in Forex, so if you're looking at, say, for instance, the US dollar, Japanese yen, this, I mean, does that look familiar? That was like this is similar to the interest rate stuff that we saw, right? Or kind of the oil, but not exactly. It's more like the interest rate because it's being driven by the interest rates. But if I compare instead AUD, JPY, Aussie yen, you can see that looks similar as well. Why? Well, because with these newer higher interest rates, people are just eager to short the yen against higher interest rate paying currencies. And so I feel like the Forex world is going to have a lot of trades coming up that are going to trend more strongly. I mean, we don't see that same move in the euro, but look, see, it's a very choppy, messy trade. But where's it going? All in favor of the U.S. dollar. And so, if the U.S. dollar, if the Fed are going to continue to raise rates through the whole year like they are, the U.S. dollar is going to continue to strengthen. And so, we have the potential for some really long-running trades in Forex. How do you take advantage of them? Well, these scale-in techniques I'm going to describe are a way to incrementally increase your gains without increasing your risk along the way. Hugely, hugely important. I'll show you how I used these techniques to actually create a trade that profited 20 times what I originally risked on the trade. The payoff was 20 to 1 over the course of just a week. And anyway, so that's the kind of stuff that we're going to be talking about in the classes that are coming up. So if you're interested, be sure and check them out. This has been a great time. I really have appreciated getting the opportunity to present to you guys, and I hope that the information I've been delivering to you has been useful. And I look forward to seeing you in conjunction with Actions to Wealth in one way or another in the months to come. Until then, everyone, take care and trade well.